We're going to now turn to the legal side of things and look at, from an estate planning perspective, from a business succession planning perspective, how can we take Naomi and Greg's estate and their planning and make sense out of it and rationalize it. And for that, I'd like to introduce my partner, Caryn Kepler, and my of-counsel attorney, Teresa Skaine. Teresa's going to go first and talk about the corporate side. I met Teresa at a bar association meeting about 5 years ago, and in fact, at the bar at a bar association meeting about 5 years ago. And we just had a casual conversation. I found out what she did, and I said, boy, wouldn't that be a nice addition to the Pierro, and Strauss offerings? And she represents corporations, businesses. She does mergers and acquisitions, commercial real estate. But she and I have had some very interesting cases and good times working with business clients with the corporate and business aspect, and then transitioning right into the succession and the estate plan. So Teresa is going to walk us through the business in Phantom's Nest.
Great, thank you. Good morning, everyone. Thanks for being here. As Lou said, I'm going to talk a little bit about Naomi's business. And in the fact pattern, we learned she is a single member LLC, which means she's currently taxed as a disregarded entity. And she has a WBE certification. She had a fighter pilot simulator game that launched her business with the Navy. Now she has a lot of commercial gaming products, so that are a bigger part of her revenue. So she can look at, if she wants to sell, she can look at a different range of options for buyers, because she doesn't necessarily need to rely on that WBE status, but she still does have it. So, talking about potential buyers for her business. She's been approached by a couple of private equity firms. As Mitch said, she, at this point, wants to continue in the business, wants to retire out of the business and kind of see it through, maybe leave some wealth to her children, maybe have her stepson come and help her run the business. So we're not really looking at private equity sales at this point for her. If we don't use Mitch's Section 1202 C Corp plan, our advice to her would be to recapitalize her LLC, put Thomas on the management track, and eventually be able to sell him some of the equity of the company, but still leave a larger portion of the wealth in her company to be able to pass down to her own children. So how do we reorganize the LLC? And what does that look like? We would recapitalize her LLC, which is basically separating incidents of ownership from voting ability in the company. And because it's an LLC, we don't have to do any amendments to the organizing document. We simply amend the operating agreement to create voting interests. We usually use a 2% voting interest and then a 98% non-voting interest. And we separate kind of the bulk of the wealth from the voting interests in the company. And I do note here that New York is one of the few states that requires you in your organization document to say whether you're member managed or manager managed. A lot of states don't require that, but New York does require it. So if we get to the point where down the road you're going to hear Caryn talk about moving these interests into trusts, if we get to that point, but Naomi wants to retain management of the company and name herself a manager, we would have to amend the Articles of Incorporation to create a manager-managed LLC. New York requires that. So the new LLC interests. Naomi owned 100% of Phantom's Nest to begin with, so after we create the voting and non-voting shares, or interests, she would continue to own both of those. She would keep the 2% voting interest. Probably at this point, we would advise her to keep that individually. Sometimes we will advise our clients to move that 2% voting interest into what we call a management trust. And again, as her business grows and becomes larger in value and more profitable, we'd probably get to that point where we'd move that 2% interest into a management trust. But for now, we're going to keep it in her individual name. And we're going to create for Thomas an equity appreciation rights plan. In a corporation, you probably heard it called a phantom stock plan. We value the company at the time we create the plan. and then we look at growth over a certain period of time. Could be sales benchmarks, it could be percentage of growth. There's a couple of different measurements that we use in these equity appreciation rights plans. And Thomas, as a participant in the plan, would get a portion of that growth as a credit into his plan account. And then there's a trigger date down the road. It might be 10 years, it might be when Naomi retires, it might be when the company's sold. He gets that credit towards purchasing some of the company. And we would give him maybe 0.5% of the voting interests to keep him in the management, keep him in the company, but then the bulk of the wealth is still in Naomi's estate or in her trust, which I'm going to get to in the next slide. And the equity appreciation rights plan also, if there are other employees in the company that she decides maybe she would like to give ownership to, that plan is broad enough she can do that as well. Excuse me. So I added in here, I'm sorry.
Can you discriminate on the airplane to keep up, say, like 2 members in that bill and not the other 2? Is there a problem with that, or is it?
Repeat the question, please.
Can you specifically design to discriminate against certain people? Like, can you discriminate against other managers saying, I want these 2 but not those 2, or does it have to be open to all managers?
It depends on levels. So if you've got senior vice presidents, it has to be all senior vice presidents. If you have vice presidents, it doesn't have to be both senior and regular, but level, you have to, yes. So I just added in, again, for the operating agreement, a lot of our clients will do things in their business and they will make changes and they will do something like what we've suggested, but then they won't actually change their operating agreement. So if we do this equity appreciation rights plan, Thomas ends up 10 years from now buying some of the interests, but we don't change our operating agreement to include buy-sell provisions, then Thomas has the ability to, sell his interest to his neighbor because he's mad at his stepmom someday. So we constantly are talking to our clients about making sure your documents are up to date. You're amending them when things like sales, new members happen to make sure that, in this case, Naomi wants to keep it in her family line. So the 98% non-voting interests, we generally would advise gifting or selling those into a BEAT, beneficiary.
Effective inheritors trust.
Thank you. I'm a corporate person. So. The BEAT is a grantor trust. So again, for now, that would preserve her WBE certification if she decides she still needs that and wants to use it. That allows her to keep that certification, but it allows her to hold the bulk of the wealth of the company in her estate for her children and have that passed down. And Caryn is going to talk in more detail about trusts because that's what she does. So thank you.
Thank you, Teresa. How many people out there? How many people out there have clients that come in with pristine corporate books and minutes for every year that they've been in existence and all the documentation and resolutions that they're supposed to have? Everybody, right? Every client that comes in owning a business has all of that. Virtually none do. And so having the ability to clean up the corporate books and records, have accurate agreements, have everything documented properly is crucial. If you've ever been through a litigation with a company, which I have, all of those things are going to be demanded and discoverable. If you've ever been audited, and we have, all of those things are going to be discoverable on audit. So the combination of the corporate and the legal estate planning is absolutely vital. And again, we've been having a great success with clients getting both of those served at one table and at one session. So now we're going to turn it over to Caryn Kepler, who is a partner at Pierro, Connor & Strauss, as soon as we get the slides fixed, but she'll do her best. Caryn has expertise in a number of different estate planning areas, works with family offices, works with international and domestic clients, and has subspecialties, as she was alluding to, in cryptocurrency, art, both for artists and collectors, and also in the LGBTQ community. Caryn.
Yes, and so, good morning, everybody. And so I have always been working with a lot of unmarried couples. In the past, a lot of those unmarried couples were LGBTQ, but they all have the rights to get married now too. So planning for them has become very, very similar to what we're doing with respect to any couples who are married or are looking to get married. So, for starters, as of today, the federal estate and gift tax exemption is $11.7 million per person. That means that anybody can transfer $11.7 million during life and at death combined to anybody without incurring any federal estate tax, or gift tax for that matter, or $23.4 million when you're talking about a couple, an advantage of being married. But however, in New York, we're looking at a New York State estate tax exemption of only $5.93 million. And on top of that, we have what we call a cliff, because once you reach 105% of that $5.3 million, you have no exemption in New York. That basically means that the tax on an estate of a little over $6 million is going to be astronomical in New York, even if you're not going to be having a federal tax. The good news, however, is that unlike the federal government, New York State does not bring back into your estate gifts that are made more than 3 years before death. So if we do proper planning with a couple, or even with an individual actually, if we do proper estate planning and our client has the good fortune of surviving 3 years, we can get huge amounts of assets out of their taxable estate for New York and possibly avoid the imposition of the cliff. The other difference between the federal and the New York State estate tax rules is we have the concept of portability on the federal side, which means that to the extent I don't use my full $11.7 million of federal exemption, I can basically give that to my spouse, or my spouse can inherit it upon my death. That does not exist at all in New York. So when we're planning for people in New York, we have to take that into account. Now, here's our cliff. So the tax on an estate of $6.2 million is $538,000. Where did that come from? Okay, you're basically adding $300,000 worth of assets, and you're getting an estate tax of over $500,000. We add the transfer taxes to the income tax rates, and we end up with a situation in New York, which is a very high tax state, as we all know if we live here, where our combined rates for income tax can be as high as 39.6% or 55.3%. Will sunset down and on December 31st, 2025, down to 39.6%. And our maximum capital gains rates are 20%, 28%, by the way, on most collectibles. And for New York State, and New York City, we have combined tax rates basically ending up at 38.3%. Now, we talked about the federal sunset. Remember that the federal exemption was increased as part of the Trump tax cuts back in 2017, and that was passed on reconciliation measure, which means that whether or not the Congress decides to carve back the federal exemption with the Build Back Better Act, we're still looking at a situation on January 1st, 2026, when we're going to be back to the previous exemption. There has been some talk of it going back as low as $3.5 million, but I believe the general consensus is we're looking under the Build Back Better Act, but it will be going back down to $5 million adjusted for inflation on January 1st. So we have lots of reasons to use our exemptions today. We're looking at the reduction in absolutely mandatory, looks like reduction happening is no later than the end of 2025. We want to remove future appreciation from the estate, especially in a couple like Naomi, like we're dealing with here, because they're young. They have many years ahead of them, and we suspect that their assets will appreciate. We want to utilize a grantor trust burn, which I will talk about as we go on. We're also in a historically low interest rate period. So when we talk about valuations of gifts, we have what's called a hurdle rate. The valuation is usually dependent upon published federal rates, and if we can produce, if our assets that we're giving away actually appreciate more than that federal rate, we have basically removed excess appreciation, and we've passed that hurdle. We want to be able to use discounts wherever possible now. There was a provision in the original Build Back Better Act that was going to take that away, and it's been something that's been in the news and spoken about in Congress for years, so there is a chance that that still may happen. There is no portability of GST exemption, even though there is portability of the estate tax exemption for federal transfer tax purposes. But remember, we now have no New York State gift tax, but we have the 3-year clawback. So when we're planning for a couple, we want to make sure that we can utilize as much as we can of those things. Here's our hurdle rates. As of November, the short-term AFR, which would be for a loan of less than 3 years? Yeah, 3 years. The midterm is 1.08. Long-term, which would be up to 10 years, is 1.85, and the 75/20 rate is 1.4%. Properly invested assets are usually going to be exceeding those rates. When we're in a low interest rate environment like we have now, there are certain types of estate planning techniques that we've been using throughout the years that work better than we do when we're in high interest rate periods. So we're favoring, at this particular point, GRATs, sales to intentionally defective grantor trusts, which I'll talk about, charitable lead annuity trust, private annuities, split dollar life insurance, which I am sure there'll be further discussion on later, spousal lifetime access trust, and BDITs, which is one of the things that we're going to be suggesting for our couple here today. As I said before, the original Build Back Better Act was basically took the Green Book on estate planning and was looking at getting rid of all of the techniques that we basically have been using in the estate planning field since before I was practicing, and I've been practicing a long time. The good news is that right now those provisions are not in there, but they're still floating around, and there is that possibility. So what is an intentionally defective grantor trust? An intentionally defective grantor trust is a transaction whereby the grantor creates a trust which is defective for income tax purposes, but is a complete gift for transfer tax purposes. And because it's defective for income tax purposes, the grantor and the trust are the same entity for tax purposes. So transactions between the trust and the grantor are not subject to any taxes. So we can have sales without any recognition of any taxable event. And in addition, the grantor ends up being taxable on all of the income that is earned in the trust. So we have a burn, which is the taxes that the grantor is going to be paying during his lifetime is another way of decreasing his or her taxable estate going forward. So if we have the sale, there's no capital gain. the interest, and what usually happens is the assets are sold in exchange for a note. The note is usually either funded by some seed money going into the trust so that the trust has the money to pay the interest and the payments on the note. And at the end of the term, when the note is paid up, the assets belong to the trust, they're out of the grantor's estate, and everything's all well and good. We like to do these trusts outside of New York. New York has some very restrictive trust laws. You know, I'm admitted in quite a few states, and I remember when I was sitting and taking the Florida bar exam, and I was being told what we could do in Florida and what we couldn't do in New York was kind of totally amazing to me, including little things like pulling a will apart before you take it to the court. You never do that in New York. But so we look at a lot of jurisdictions that are much more favorable for the creation of trusts. And one of those jurisdictions is the state of Delaware. Delaware allows you to create a trust for your own benefit, which is what we call a self-settled trust, which would provide you protection from your creditors after a certain period of time. Delaware also has no rule against perpetuities, and anybody in this room who's been to law school can tell you that that's the one class that you're never expected to necessarily understand or pass, or the questions on the bar exam that you're never expected to get right. That the rule against perpetuities really talks about the fact that you can't, whole property can't be tied up for an extended period of time. So in New York, that's lives and being plus everybody who's alive on today's date, 21 years after everybody's dead, all of those people are dead. There is no rule in perpetuities in the state of Delaware, so trusts can go on forever.
10 minutes, Caryn.
Excuse me?
10 minutes.
Oh my goodness, we got a lot to go on. So I'm gonna just keep going. I'm gonna flip through all these, I'm going backwards. I'm gonna skip through all of these, and I'm going to run right over into the beneficiary defective inheritors trust. And this is the kind of estate plan where your client can have it and eat it too. I've seen clients for years who tell me, I want to have control, I want to have the income, I don't want to pay the taxes, basically I want everything. And this is the way that we can help them get as close as possible. So we would leverage the benefits of an irrevocable Delaware trust for Naomi. She would maintain control of her business. The assets that are in that trust are going to be protected from creditors. They're not going to be subject to estate, gift, or generation skipping taxes. And Naomi is going to be the trustee and the beneficiary. So how do we do that? The beta is created by somebody else other than Naomi. So in this particular case, Naomi's dad is going to be creating a trust for Naomi's benefit. He's going to fund that trust with $5,000. And Naomi's going to be given the power to withdraw that $5,000 from the trust. That alone will make the trust effective for income tax purposes, so that the trust and Naomi will be unified as taxpayers. No other gifts are going to be made to that trust. Then the trust is going to buy Naomi's business. And because she will be the income taxpayer, she will continue to be taxed on all of the income from the trust. She can utilize and control the trust assets because she can also be the investment advisor, because the state of Delaware also allows us to carve up fiduciary duty, which we can't do in New York. And she can control the distributions because she can also be a distribution advisor. So she's going to have complete access to everything that's in that trust during the time that she is alive. She can also have a limited power of appointment to change the disposition upon her death. So so circumstances arise, and that she might want to disinherit one of her childs, or maybe take her significant other's child and make him a beneficiary. She can do that too. There will be an installment note for the sale. If it's not funded with a 10% seed money, it can be guaranteed. And in this case, we would probably have Naomi's father guarantee that note because we know he can afford to pay it. The interests from that are not going to be taxable to her at all because she is the taxpayer. So in addition to all of this, there's going to be money in the trust that could potentially pay for life insurance policies on Naomi's life. There will have to be restrictions within the trust so that Naomi does not have control over those insurance policies, because the control of the policies is what actually causes the estate tax inclusion. But she can not just be insured here, but she can indirectly access the cash value of the policy if need be, as long as there's an independent trustee. So what have we done? We've frozen the value of the business for whatever it was valued at the time of death. Assuming that the note is paid off before Naomi dies, there's no portion of the business in her estate at her death. Of course, if she dies before the note is completely paid off, we have the remaining balance due on that note is an estate asset, but that is it. And it's not going to require any use of her exemption because this is a sale, it's not a gift. So the result, she's retained control, she's got asset protection, the future growth in the business is protected from creditors, including future spouses of her children, which I always tell my clients, those are the ones you really got to watch out for. She has been paying income tax on the income earned by the business, so that has further burned down the value of her estate. And she has multi-generation tax, divorce, and lawsuit protection for her children over the course of the trust. Thank you.
Thank you, Caryn. Ben, you have a question?
Yeah, but how exactly is the note being paid off during her lifetime? Or isn't she just receiving interest payments on the note?
Yeah, it's an interest-only note. And the question is, what are you doing with the note? And so it can be a 30-year interest-only note at 1.85%. That's our long-term AFR right now. And you would pay interest. The question is, what do you do with the note after the Beat It is funded and set up? Is there any restriction on gifting the note? And the answer is no. So she could actually gift the note to a trust for the kids and use the $11.7 million exemption that she has by gifting the note rather than the business and putting the business and selling it into the Beat It. So there is a lot that can be done with the note. Ultimately, the beneficiaries are the same people. So you're going to have the beneficiaries of the Beat It and the beneficiaries of the note, whether it be held in a revocable trust or whether it be gifted to a gifting trust and using her lifetime exemption, they're going to end up being the same people. Another question in the back?
Yes. How do you value the note if you gift it? You know, there's a difference between the net rate that you have to charge versus your true market test, which would reflect market effects.
So would the note be not worth the face value of the note is the question. Would you need to value it? And we do happen to have a valuation expert on the panel.
I can even talk talk about that. Yeah.
It's a great question. I'll pass it over to Caryn afterwards, but typically a note would be valued based on the market yield and then the interest rate. So if you've got 2% AFR, but a 5% market rate, you do a discounted cash flow analysis and it would be worth less than face value.
Yeah, I'm just going to add to that by saying the note is the promise to pay in the future. And so the value of the right to receive money 10 years from now is not dollar for dollar what it is today. So when I started out my career at the IRS, so this is one of the things we were doing all the time. The government publishes these interest rates on a monthly basis. And so you take the length of the note, you take the interest rate of the note, and you look at the current interest rate for the month in question, and you actually basically go to a chart, and it tells you what the value of the note is based upon those factors. Does that help you too? Well, it's actually the same answer. In different terms, yeah.
Right. I think it's just a way of determining the market yield, which could be based on various factors, including the IRS sort of specifications. But the spreadsheet that Caryn and I are both describing is that you have a contractual interest rate, you have the yield that needs to be plugged in, and the two numbers, as you point out, could be different. And if the appropriate yield is above the market interest rate, then the note is worth less than 100 cents on the dollar.
So many people haven't heard of the Beat It Trust. How many people before today didn't know what a Beat It was? A lot of people, and a lot of very sophisticated planners don't know what a Beat It is, and you expect to hear Michael Jackson singing in the background when you introduce the topic. But I've been over the years through a series of changes in attitudes towards trust law, and I remember being at a dinner. I spoke at the New York University Tax Institute probably 20 years ago, and I was listening at a dinner with a debate between someone who was a big fan of Gratz. We called her the Queen of Gratz. You may know who I'm talking about. But grantor retained annuity trusts, and a gentleman who thought that a sale to an intentionally defective grantor trust was a perfectly legitimate technique. And the big question was, if the grantor is paying the income tax on the growth inside of the trust and on the income inside of the trust, is that an additional gift to the trust, which would have to be reported and using gift tax exemption each year as they pay that income tax? And the gentleman that was arguing for that proposition, that it was not an additional taxable gift, ended up winning. And there was a court case, a revenue ruling that came down from the Internal Revenue Service to say, yes, sales to intentionally defective grantor trusts are fine. The payment of income tax is not an additional gift. That gentleman went on to then take the concept one step further and use section 678 of the code to create a trust that Caryn just described, which is a third-party trust. So created by a parent, in this case for a child, but which could then be a grantor trust as to the child, which was kind of a radical concept. But it has now become widely accepted. That trust has been in use for 15 plus years. We've never seen a challenge. Some people are a little skittish. The note issue, a lot of people feel like you should go market rate as opposed to AFR on the note, just to make it look more like a commercially reasonable transaction. But if you're going to gift the note and you want to put additional money into the hands of the children, you'd want a higher rate because you want to pay that interest into a trust that's also outside of your estate once you've gifted the note. So there's a lot of fine-tuning of the plan as you go, but we now have about 4 of these teed up. Anthony Kachui, our associate, is working on all of them. And so it's a technique that we think is valuable. And in the alphabet soup of slats and grats and cruts and grits, and you now have Beat It on top of all that. And Delaware is so key to this because you can have an independent trust protector, you can have a distribution advisor, you can have an investment advisor, and all of the features of Delaware law don't exist in New York yet. New York has a trust law that has been proposed now for 5 years. Ira Bloom, my former professor, wrote it. It's been in the state legislature for 5 years, which would bring us fully directed trusts and trust protectors and a whole series of other modernizations of New York's trust code. But until that happens, a lot of people think it's almost malpractice to do these kinds of high net worth trusts under New York law, because there are so many advantages to Delaware. Our next speaker happens to be from a Delaware trust company. We also have an independent trustee from Delaware who came up to be with us today, Teresa Hughes, who's spoken at this conference. Stand up, Teresa. And Teresa's kind of unique. She is an individual trustee in Delaware who works with families. And when you have small businesses, as most of you probably know, corporate trustees don't really want to manage a business. So in a Delaware trust, you can have an independent administrative trustee and an investment advisor, which could in fact be Naomi. So she's going to continue to manage the business inside of the trust with full administrative functions from a professional trustee. It's an arrangement that works extremely well for business owners.